Good afternoon. I'm Shelley Jones, Assistant Director of Alumni Engagement at Missouri State University. The Alumni Association is the organization through which Missouri State students continue their connection with MSU when they leave the university. The Alumni Association is a non-dues paying organization, so all of our alums, well, you're viewed as members. If you are new to our BearTalks series, these are webinars that are monthly professional development sessions now available in a virtual format. So how the webinar will work today, we can't see or hear you. You'll use the Q&A feature for any questions you may have, and we'll do that towards the end. Today's session is being recorded, and all registrants will receive a follow-up email either tomorrow or early next week from the Alumni Association with additional resources, contacts, and the link to the recording. Unfortunately, due to time limitations, we will not get to every question. So today's topic is Investing 101, and we have had a record number of registrants for this session, including Missouri State University President Cliff Smart, who is watching with you all today. So thank you all, President Smart, for being here, as well as all of you. Next, I'd like to go ahead and turn it over to our moderator, Dr. Jeff Jones, MSU Department Head for Finance and General Business, so he can get us started. Dr. Jones?
Well, thank you very much, Shelley, for that introduction, and I'm pleased that you all are joining us today for this BearTalks session on Investing 101. So I'd like to actually start out today with a quick poll, and so Candace, if you could pull up that poll for us. This is regarding your investing knowledge. So which best describes your level of investing knowledge and experience? And if you could, we'll give you about 10 or 15 seconds here if you will answer this question. And then we will view the results. Okay, so looks like our most common response is I want to get started, but don't know how. So this will definitely be, I think, the webinar for you. We will talk about that. That was one of the most common questions among the nearly 100 or so questions that were submitted in advance for this particular webinar. So Candace, if you would, could you bring up the PowerPoint presentation? And we'll get started. So as Shelley said, I'm Dr. Jeff Jones, the department head for the Finance and General Business Department. Our panelists today are Rhonda Christopher, who is with BKD Wealth Advisors, and Mark Scott, who is with Tower Wealth Managers. And both Rhonda and Mark are alumni of the university. And so I'm actually gonna, if you would, Candace, advance to the next slide. I want to talk a little bit about what to expect and what not to expect from today. So today is really about education. It's not about giving you a specific investment strategy or recommending any type of specific investment. And there will be some disclaimers later in the presentation that will allude to that point. Also, as I said, we had a very large number of questions submitted in advance. We will not be able to get to every question, but both Rhonda and Mark will do a presentation here that is designed to answer kind of the most common questions that we received. At the end of the webinar, we will then have an opportunity for Q&A. So the topics that we will address, first off, getting started finding a financial planner. And that, I think that's great because that kind of goes along with the poll we just had, kind of the most common theme, hey, I just need some help getting started. We'll also talk about time value of money and market timing. We'll also touch upon taxes and different types of investment accounts. We will talk about the principle of diversification, which is incredibly important in investment management, as well as overall asset allocation and portfolio management strategies. One other thing I want to point out, we did have several questions related to cryptocurrency. That will be the first question out of the Q&A session. So if you were interested in that topic and didn't see it on that list, stick around to the end. So it's my pleasure now to introduce Rhonda Christopher with BKD Wealth Advisors, and I will turn it over now to Rhonda.
Good afternoon, everyone. And Jeff, thank you so much. I appreciate being a part today of the presentation. So I'm going to be talking some about several different topics. And the first one is financial planning. So you think as you begin investing, there are a lot of decisions to make, and a financial plan can help you identify your needs and goals for the future. And really, instead of investing without a purpose, it's investing to a purpose. So on this slide, as you start thinking about financial planning, there's some factors that you could control. You can control your saving, how much you save, how much you spend. You can control how you invest, what you invest in. You have some things that you have some control over, your employment, where you work, what you earn, how long you work, and how you take control of your health. And there's some areas that are out of your control, like what the market does and what happens with policy like taxes. So you use a financial plan to make the best decisions that you can, taking the factors into account you can control and also considering those that you can't. So the logistics of doing a financial plan is that you determine what your goals are. So what are you working towards? It may be retirement, it may be a new home purchase or some other future purchase. So what does that look like? What are other sources you have to help fund that goal? And then how do you need to invest to provide the growth that's needed to get there? So again, the goal is to structure your investment activity to help you reach your goals versus just taking what you get at the end without making those decisions with any context. The next slide gives some information about how do you find a financial planner. Now, some folks are do-it-yourself people, and you want to go in and do the calculator yourself, and you can find some pretty good calculators online. They're pretty simple, but they can show you based on the level of investing you have now and your savings rate, how much will it grow to be in the future when you consider investment growth and compounding. If you participate in your employer's 401k plan, a lot of the custodians or that's the company you get your statement from, have some pretty good calculators as well. And they can help you look at what your salary is now, look at your savings rate, and determine what percentage of that salary will you have saved by the time you retire. If you're wanting to hire a professional planner, you might look for someone who's a CFP, which is a certified financial planner, or a CPA with the PFS designation, which is a certified public accountant with a personal financial specialist designation. Because these are individuals that are trained in that, they have the skill set to take all the variables that go into a financial plan and provide that plan for you. You can find these type of professionals through the Financial Planning Association website. You can talk to your CPA or your tax preparer, your local bank, your brokerage firm, whoever that trusted advisor is that you would go to for recommendations, or you could ask your friends for referrals and who they've worked with and if that was beneficial to them. So then another question we had was asking about risk in investing. Is there risk in the market? And there is risk in investing. There's all different kinds of risk. There's market risk, which is just the risk that the value of your investments are going to decline. There's liquidity risk. Are you going to be able to sell your investment and get a fair value when you need it? There's inflation risk. Are your investments going to keep up to inflation and actually exceed them? So you're increasing your purchasing power. Or longevity risk. Are you going to outlive your investments? So you really have to take all of these into account as you're making your investment decisions. There's two basic types of investments that I want to talk about briefly. You have stocks, which are equities, and that's basically ownership in a company. And there's bonds, which is debt, and you're basically loaning money to a company, and they're going to pay you a stated rate of interest at the end of the term. And they behave very differently in response to what's going on in the market. Stocks generally are, they have greater long-term growth potential. Historically they have, but they're much more volatile in the short term. Whereas bonds don't have as much appreciation opportunity. You buy a bond more for that interest, that stability, but they don't react to market activity as much. This chart is a really good visual of that reaction over a very short time span. This is going from January 1 of 2020 to March of 2021 during the pandemic. So you'll see we start out at the beginning of January 2020, investments are all moving pretty much together, moving up. And then the effect of the pandemic starts hitting international first. and then US, and you'll see the value of those indexes drop. And at one point at the end of March, they're down around 30% or even more. You'll see bonds also react to the market drop, but their reaction is much smaller and they recover faster. You kind of move along the rest of the year pretty steady, whereas it takes a while for stocks to regain where they started at, but they went on during the course of the year and exceeded where bonds were as far as growth is concerned. So again, this is a pretty compressed time frame. This was actually the fastest drop in the market in history and the fastest recovery. But it shows you really well how stocks are much more volatile than bonds are. So the lows are lower and the highs are higher, whereas bonds are pretty much steady going all the way through. And I think Mark's going to talk about this more later when he gets into the second part of the presentation. The next slide shows you when you have combinations of stocks and bonds, what the reaction is. So this is the same time period. On this chart, the bottom line, the green line, is all the S&P 500, so 500 of the largest US stocks. The light blue line in the middle is a combination of 60% stocks and 40% bonds in a portfolio. So more stocks than bonds, but a combination. And then the darker blue is the reverse, only 40% stocks and 60% bonds. So all of those portfolios dropped in reaction to the pandemic. You'll see the S&P 500 dropped the most, the portfolio that has more stocks and bonds in the middle, and then more bonds and stocks had less reaction. The portfolios that were more bonds and stocks recovered quicker, but didn't grow as much through the end of the year. It took a while for the 60-40 portfolio and then all stock portfolio to recover, but then went on to do better at the end. So this is one of the important decisions that, again, Mark will talk about more, is how do you determine what that right mix is? So then you may say, well, I don't want that volatility. I'm just going to sit on the sideline when the market gets choppy, and I'm going to wait to get back in until I feel more comfortable. Well, the problem is you have to be right twice. You have to be right to know when to sell, because you want to sell before the bottom of the market. And then you want to get back in right at the market, so you have opportunity to take advantage of the recovery. This chart shows for the past 20 years. So in January 2001, if you invested $10,000 in the S&P 500 index, all stock, 500 of the largest US companies on US indexes, and you stayed invested for 20 years. So this is through the Great Recession of 2008. This is through the flash crash of 2010, the pandemic. The whole time you stayed invested. At the end of that 20-year period, your $10,000 would be worth $42,231, and you would have averaged 7.47% return a year. However, if you got out of the market and you just missed just the 10 best days in 20 years, just the 10 best days, your 10,000 would be worth 19,000 at the end of 20 years, and your average return would be 3.35%, half of what it would have been if you stayed invested the whole time. If you missed the best 20 days, your 10,000 would be worth a little over 11,000. And if you missed the best 60 days of a 20-year period, your 10,000 would only be worth 2,441, and you would have an average loss in the portfolio. So you have to think about, how long would it take to feel comfortable to get back in? If you get out because you don't want the volatility, would it take you a few days or a few weeks or even a few months to get back into the market? Well, during the same time period, 7 of the best 10 days in the market occurred within 2 weeks of the 10 worst days. So if it took longer than 2 weeks to get back in, you would have missed 7 of the best 10 days that were out there. There's a few other statistics there. About 6 of the 7 best days occurred after the worst days. And the second worst day of 2020, which was March 12th, was immediately followed by the second best day of the year. So I think the general takeaway from this is that the time in the market is more important than timing the market. Find an allocation that's right for you and that you're comfortable with, and stick with it. So then some folks may say, well, it's different this time. Whatever is going on, it's different. It hasn't felt like this before. The psychology and the emotion of investing is really interesting. But this next slide, it it has a visual that I think gives you some really good information. This is for the past 41 years, and each year is represented by a bar and then the dot below the bar. So the red dot below is the largest market drop during the year, and the bar represents what the return ended up being for that year. So you'll look for 41 years, every year at some point, the market had a drop. And during this period, there was an average intra-year drop of 14.3%, but yet 31 of the 41 years, the market ended up being positive. So again, when you start investing, it's important to have that plan and be mentally prepared for the volatility that goes along with the stock market, because that's normal, that will happen, but be able to stick with it when that volatility comes. So the last thing I want to touch on kind of quickly is the types of investment accounts. When you get ready to open an account and start investing, there's several different ways to title those accounts, and each one has different tax implications. So you want to understand those because it's not just what you earn, it's also what you're able to keep. So the first category are taxable investments. So these would be titled, accounts titled individually in your name, a joint account, titled in a revocable trust if you've done some estate planning, but it's under your Social Security number. And these are considered taxable because each year the custodian is going to send you a 1099, and that 1099 is going to tell you how much did you earn in interest, how much did you earn in dividends, how much gain did you have or loss from selling investments, and all of that information is reported on your tax return. Now, it may be taxed at different rates. So interest is ordinary income at a higher rate, whereas long-term capital gains and qualified dividends are at a lower rate, but still it all gets reported on your tax return in the year it's earned. Whereas the next category is tax deferred. So these are your IRA accounts, a traditional IRA or a rollover IRA. So unlike the taxable account, it is not taxed based on what happens inside the account. It can have interest, dividends, and it can grow, and all that happens with no tax implications. Instead, when you start pulling money out of that IRA, then you'll get the 1099 for the dollar amount that you pulled out, and that goes on your tax return, and you're taxed at that point as ordinary income, which is at your highest tax bracket. So the third category is tax exempt investment accounts. So these are Roth IRA accounts. So unlike a traditional IRA that in some circumstances you get a tax benefit for contributing to it, you get no tax benefit for contributing to a Roth. But like a regular IRA, the activity inside that account is tax deferred. It grows, interest, dividends, there's no tax on it while it's inside that account. And then as long as you hold that account 5 years, and you wait till you're 59 and a half, when you pull money out of that account, it is still not taxed to you. So it truly can be a way to invest and let it grow tax deferred and pull that money out later with no tax implications. In addition, a Roth IRA doesn't require you to start pulling money out when you're 72, which a traditional IRA does. So it's a good vehicle for someone too who's looking at a good way to invest money that they may not want to spend or think they need to spend and want to have it to pass along to their beneficiaries. All of these different types though have criteria for who qualifies. So you need to talk to your tax advisor or your investment advisor before you set them up. So those are the questions I was going to handle right off the bat. So Jeff, I will turn it back to you.
All right, Rhonda, thank you so much for that information. Now I'm going to introduce Mark Scott with Tower Wealth Managers, and he's going to help answer some more questions for us. So Mark, please take it away.
Thanks, Jeff. Happy to be here. So I'm just going to first touch on, there were several questions around, how do we get started? So Rhonda addressed, if you want to consult a financial planner, a couple of resources there. I'm more going to talk about the do-it-yourself side of things. So, frankly, it's not really that complex to get started. Initially, we need to open up an account. I would tell you most of your large brokers that you guys have heard on, I would research them online, decide who you're comfortable with. A lot of those allow you to open up an account online. And frankly, what I would look for is trading costs, fees, things of that nature. Anymore, it doesn't really cost much, if anything, to trade. So those would be things that I would look for, just to initially set up a brokerage account. Once the account is set up, really you just need to decide, how much you want to invest, and what are you really interested in investing in. So we'll spend a little more time on this, but I think initially, we'll jump into diversification, as Jeff alluded to at the beginning of the presentation. To me, that's one of the most important things one needs to think about, is diversification. And kind of one of the second things that I at least normally practice myself is the idea of dollar cost averaging. So the idea of that is, let's say we have $10,000 that we want to invest in the market. I generally would not put that all in at once. We can decide what is the appropriate time frame. Maybe it's $1,000 a month for 10 months. Maybe it's $2,500 a month for 4 months. Maybe it's $2,000 a week for 5 weeks. A lot of that is sort of preference, but the reason that I would think about dollar cost averaging into the market is, as Rhonda alluded to, there's going to be some volatility in the market or variability, and you want to sort of smooth out your purchase price. So those are things that I would think about, and we'll jump into, as I said, diversification more here in a second. But once we sort of decide on all of that, we just start trading. And we'll talk more about here in a minute, just kind of ways that I think about setting up a portfolio. And the next slide here, we'll jump into diversification. So really, I think everyone has heard this principle before. Don't put all your eggs in one basket. It holds the same for me in investing. I wouldn't put all my eggs in one stock. I wouldn't put all my eggs in one commodity, one cryptocurrency, as Jeff alluded to, we'll be talking about later. So as we think about things as a firm, I generally have a hard and fast rule of no more than 10% in one stock of the entire portfolio. But generally, I would prefer that to be no more than 5%. And the next slide sort of talks to those points. So this is a slide from the CFA Institute. This actually just came out here in the last couple of weeks. So what you'll see here is the blue line represents small cap stocks, meaning stocks that are very small in value. Small caps generally defined by a company worth maybe $5 billion or less. And the red line represents large cap stocks. So these are stocks that are worth a lot more, probably generally starting around 30 or 40 billion. And if you think about the market, this goes all the way up to $2 trillion or so, which would be Apple, the largest company in the world. So as you look at this slide, what it's depicting is the standard deviation, which is the numbers there on the left that go from basically 0 to 60%. The standard deviation is a measure of volatility of your portfolio. So what a 60% standard deviation means is that your returns, let's say they're normally, the average is 10%, but if you have a 60% standard deviation, that means on average, you should not be surprised if your 10% average return in 1 year is up 70%, so 60% above the 10, or is down 50%, or 10 minus the 60. So there's a lot of volatility when you own one stock. And as you look at this chart, sort of the sweet spot for me, at least on large cap, is when you get to about, say, 10 stocks or more, you fall below the 20% volatility. And then small caps, you need to own more stocks there just because they're riskier. So I would say there probably 20 to 25 stocks or more is kind of a good ballpark. And that goes to what I just talked about, the 5 to 10% range of one's portfolio, that I generally wouldn't own more than that in one stock. And again, the 10 is our max. I generally would never buy a stock to 10%. You know, I would probably purchase up to 5. So that's a little bit of color on diversification from a stock specific perspective. The next slide talks about, you know, just look at the equities. What should we think about? So as I'm building my portfolio, I want to think about the entire spectrum of stocks that I have at my discretion. So what I mean by that is domestically, I would think about large cap stocks, so like an Apple, but also we need to think about, in my opinion, small cap and mid cap stocks. And the reason is, you know, frankly, you want to own the next Apple. You know, we don't know who that is, but the next Apple is likely not a large cap stock. The next Apple is likely a small cap or a mid cap stock. You know, at one point in time, Apple was a small and mid cap stock. Google was a small and mid cap stock. So as I think about my portfolio, as I'm setting it up, I want to think about owning not only large cap stocks, but also mid and small. And then Rhonda talked about international markets as well as domestic markets. So that's an area that I also think is important to focus on. You know, not only do you want exposure to the U.S. market, you want exposure to you know, Europe and all the other countries. So next slide, we'll kind of talk about how I slice these portfolios. So typically a diversified portfolio, just rounding these numbers kind of down the fairway, I would say is 75% domestic, 25% international. And then of that domestic piece, 75% large cap, 25% small and mid. And then on the international piece, sort of the same, 75% developed markets, developed meaning, you know, Europe and Canada and Japan, 25% or so emerging markets. Those are, you know, up and coming countries like Brazil, India, China, et cetera. So jumping to the next slide, you know, I think, you know, we talked about the stock or the equity component of the portfolio. But as Rhonda alluded to, you know, you really need to think about, do I want to invest 100% of my portfolio just in stocks? As her chart earlier depicted, you know, there's a lot more volatility if we just own 100% in stocks. So I would argue that it generally makes sense to consider owning some bonds to smooth out the returns of the portfolio. So if we jump to the next slide, we'll see, you know, another depiction of what the volatility of portfolios are. And this is over a very long period of time. So a couple of things on this slide. The first thing is, this is data going back to 1950. So this is 70 years worth of data. The second thing is, you can see on the bottom, we have 1 year, 5 year, 10 year, 20 year rolling returns. So we're just rolling the returns over the last 70 years. The chart at the top shows the average returns. And then you can see the depiction of the bars. It shows you the minimum and the maximum return over said time period. So just, I always find this slide interesting. What I want to depict is on the far left on all of these bars, basically the green bar, that's a 100% stock portfolio. So you can see the significant volatility, especially on a 1 year basis, of a 100% stock portfolio. If you go to the right, you know, the blue bar is 100% bonds. The gray bar is a 50-50 portfolio. What is interesting to me about the 50-50 portfolio is over time, again, this is over 70-year period returns. If you look at the 5-year rolling, if you look at the 10-year rolling, and if you look at the 20-year rolling, the worst return over a 70 year that we've seen on a 5-year rolling for a 50-50 portfolio is plus 1%, 10-year plus 2, 20-year plus 5. So I think it's very interesting. It sort of helps with the volatility of the portfolio. And so, you know, those are things to consider. I'll jump to the next slide. I think I have 2 left here. We'll first touch on asset allocation plan. You know, so, you know, 100% stocks, 0% bonds, 50% stocks, 50% bonds. How do I decide? For me, the way that I like to think about it is, let's say we have $100,000. What you really need to think about is, do you need to access those funds? And what I mean by that is, of that $100,000, do you need to spend any of that in the next 3 years? For me, if you need to touch the money in the next 3 to 4 years, I would argue you should put that in bonds, just to prevent the volatility of the stock market. So, you know, simple math, let's say we have $100,000. In the next 3 years, we think we may spend $25,000 of that $100,000. Well, for me, then that says, well, I want to take 25% or $25,000 of the portfolio and put it in bonds. So for me, that would be a 75-25 portfolio. That's how I would think about it. It goes to the function of how quickly do you need to access the funds. You know, from there, generally, I would rebalance the portfolio. You know, you can do that annually, you can do that quarterly. It doesn't matter a whole lot. And then, you know, again, sort of this principle of dollar cost averaging. If we're using that $100,000 again, you know, I wouldn't put it all in the market at once. Maybe it's $10,000 a month for 10 months. So that's how I would think about that. Last slide for me is, you know, just thinking about this as an individual investor. Again, the principle of diversification, I think it makes sense generally to own mutual funds or ETFs, which are exchange traded funds. These are a basket of, you know, generally 40 to 100 stocks. So they're very well diversified. So I would think about that if I'm an individual investor just starting, wanting to do this on my own. If I am wanting to buy an individual stock, second point, I think you need to stick with what you know and what you understand. You know, hey, I go to Chipotle all the time and I eat a burrito once a week. Well, what do you think of Chipotle? Do you like it? Do you think it's going to continue growing? If you do, you know, maybe you throw a little bit of money at that stock and invest in that. That's how I would think about it, versus reading about some new technology that you don't quite understand, but it seems like everybody's investing in it. I would generally probably stray from that. And sort of finally, you know, just what I always think about in terms of investing, right? I like to think for the long term. So a perfect test for me is always, you know, do I think whatever company I'm interested in investing in is going to be bigger 5 or 10 years from now? If the answer is yes, generally it's an interesting investment unless you're paying too much for it today. So I will stop there and I will turn it back over to Jeff.
All right, thank you very much, Mark. So before we go any farther, I just do want to point out that, you know, the disclaimers associated with this presentation, and, you know, you can read these on your own time, but basically, you know, again, this is for informational purposes only. We're not advocating any specific investment or specific investment strategy. So Candace, if you could move to the next slide. And here's contact information for everyone on the webinar today. And if you would advance once more, Candace. Okay, so now we're going to begin our Q&A session. And as promised, we will talk about cryptocurrency. But first off, Candace, if you would, could you queue up the poll regarding cryptocurrency? So the question is, have you or are you currently investing in cryptocurrency? Yes, no, or unsure? And we'll take a few seconds here. Okay, let's see the results. So we've got 15% yes, 84% no, 1% unsure. All right, very good, very good. So the majority are not invested in cryptocurrency, which is what I would expect. So first question out of the gate, and Mark, I'm gonna throw it to you first. What are cryptocurrencies, and do they belong in a portfolio for the average investor?
Thanks, Jeff. So cryptocurrency, the way that I would think about it is it's a digital, basically token that you can use in some instances to exchange for other goods. In my opinion, I personally would not call it a currency. My definition of a currency is a store of value. A store of value generally means there's not a lot of volatility to it. If I'm thinking, let's say McDonald's, and I'm selling a hamburger, I want to make sure if I'm selling my hamburger for $1, that when I go to put my $1 in the bank, it's worth $1, because that's how my business model works. If I'm accepting, say, Bitcoin, I don't know what Bitcoin's going to be worth the next day. So for me, it presents an issue as a currency. And so I think of it more as kind of like a commodity. A sort of a direct answer to your question today, I personally do not own any. None of our clients own any. I personally think it is a speculative investment. So I would say if I did own any, I would go back to my diversification principle. I personally would not have any more than maximum 10% in it, but more likely in the 5% range. And I will stop there and turn it back over to Jeff, or let Rhonda give her 2 cents.
Rhonda, what are your thoughts?
Yeah, so I agree with Mark. It is not a currency. I agree with that. It's not a store of value. It's easier to tell what it's not than to tell what it is. It's not regulated. It's not backed by any hard assets, and it's not backed by any financial characteristics that let you value it. So you can't value it. Like if you have a corporation, you can look at it and you can determine what's it's worth based on its earnings, based on its cash flow, based on its dividends, and you can't do that with Bitcoin or a cryptocurrency. So it is more speculative by nature. And I think the other thing, it's, what is it? Well, it's almost more like a collectible. It's taxed a little bit differently, so there's tax implications, and it's basically just worth what someone's willing to pay for it. So the volatility is pretty dramatic with it. Will cryptocurrency continue to evolve and have a bigger place in our economy? I think that's very likely, but it's just hard to know what the worth is at this point in time.
All right, very good. Thank you both for your thoughts on that subject. I'm going to next jump to a question regarding inflation, because I had one of these come through on the chat. It was the first question in. So basically, there's been a lot of recent talk about significantly higher inflation in the coming years. How might higher inflation impact my investment strategy, and what kinds of questions do I need to be asking myself or my financial advisor to prepare for the possibility of higher inflation? Rhonda, why don't you take this one first?
Yeah, I'd be happy to. So there is a lot of talk about inflation, and I think the report just came out, and we are in a period of a spike in inflation, but I'm not sure that that's very surprising considering where we were a year ago and where we've come from. And we've been in a pretty low inflation environment for quite some time. You look at it, there's a lot of pent up demand. We've had a lot of stimulus, and we have our supply chain is not keeping up with it. So there's a drive up in costs. At this point, we have no evidence that that's not going to be somewhat transitory. Is it going to normalize a little bit more when we get our supply chain catches back up to demand? But it may not go back to where it was before, because again, we've been in a very low environment for quite some time. So I think the questions you need to be asking, and if you're doing financial planning, you need to make sure that you're adjusting your goals based on what inflation could be to maintain your purchasing power. and you need to make sure that portfolio structure you're putting together has enough growth within it, the potential for growth, that again, you're going to stay ahead of what that inflation is and not reduce your purchasing power over the years so that you can buy that house or retire in the way you want when the time comes.
Mark, any thoughts on the subject?
Yeah, I would just add a few things. As Rhonda talked about, we had some new inflation data this morning. I went through that pretty quickly this morning. So the headline inflation number this morning was up 5%. So meaning the cost of everything all in over the last year went up 5%. To Rhonda's point, there are some, in my eyes, transitory numbers in that data. And I'll throw some of these out to you and tell me if you think they're sustainable. And I think it's helpful to think about where was the economy last year and where are we at today. So the biggest component with an increase last year was car and truck rentals. So the rental market, a car rental this time versus last year, the price was up 110%. I personally don't think that is sustainable. I think what happened last year was, as we all know, we were shut into our homes, we weren't traveling much. And so basically rental car companies had to basically give away their fleet for someone to want to rent a car. We're seeing some of the same evidence in other parts of the data. Airfare prices year over year are up 24%. That's probably not sustainable. But also to Rhonda's point, I think things will be up. I think it does appear we're in a higher inflationary environment. If you look at the totality of the data, the 5% growth this month was compared to a 1% growth at this time last year. What I like to do is add the two together, divide by 2, and average it and smooth it out. So if I average it and smooth it out, 5 plus 1 is 6, divide by 2, my average is 3. And the reason I'm saying that is the 1% we're comparing against last year, as we transition through the year, that's going to move more towards 2% or 2.5%. So I personally wouldn't be surprised if the 5 that was just reported moved back down to maybe 3.5 or 4%. But that is still inflated inflation versus historical norms. So things that I think one needs to think about is, what returns am I getting on my bonds, right? It is very difficult today to get really much above 1% on a bond. So it's hard to own a lot in bonds today when you're making 1% and inflation is 3%. Other things I would think about would be, individual companies. And really, what do I think their ability is to pass through higher prices? Because where you can really get in trouble in inflationary environments are especially, in my opinion, companies that depend a lot on labor. So if labor is a very high cost and the price of labor goes up, they really need to increase their prices and pass it through. We just saw that, I think it was yesterday, Chipotle said they're raising their burrito prices 4% because wage inflation is going up. So those are things that I think is worth thinking about in an inflationary environment.
All right, thanks very much, Mark. Next question. What are your thoughts on what I'll call the memification of stocks? And so the most recent examples being, say, a GameStop or an AMC Theaters, where you have a small group of individual investors that kind of pile into these stocks and really create some tremendous volatility. Is that the start of a long-term trend, or is that a passing fad? Rhonda, why don't you go first?
Boy, that's a hard question. I'm not sure I know the answer to that question. It's been fascinating to watch what has gone on in the news with all of this. And so I think the question now is it is it something that long-term investors are going to be taking advantage of and keeping up with going forward? Or is it a more reaction to the time we're in, a more social environment, a sense of community that comes, a sense of the power to go in and affect the big investors, the hedge funds, and have impact against them? So Mark, I'm anxious to hear your response to this as well, because I don't know the answer to that.
So I'm opinionated on some of these things. So one in particular, I'm very opinionated on. This is probably one of those. So I will give you one, for instance. I'm personally not one that I want to bet against, who I think would be probably the one that would have the most information to have an opinion on the value of a company. And so an example I will give you is AMC. AMC last year, beginning of the fourth quarter, call it October last year, the stock was around $4 or $5. The stock today, you know, it's very volatile. Last I looked, it's around $40, $45. So that's significant appreciation, going from obviously $4 to $5 to $45 in 9 months' time. Well, what actually happened, if you look at the underlying fundamentals of the company, is that the board, the CEO, et cetera, in their opinion, their stock is overvalued. And why do I say that? If you look at September of last year, there were 100 million shares outstanding. If you look at today, there's 500 million shares outstanding. The company has said our stock is so overvalued, we're going to sell 400 million shares to everyone. And why are we doing that? It's because we're a sleepy movie theater with too much debt on our balance sheet. We went from $4.5 billion in debt to $5.5 billion in debt. And back to my thought process of, do I think XYZ company will be bigger or smaller 5 or 10 years from now? I mean, I would just ask everyone's opinion. Who's going to the movie theater more? Or are you sitting at home streaming Netflix? Really important, are you sitting at home streaming HBO, who has said all of our movies are not going to be in the theater, they're going to be streaming on HBO? So I personally, I don't own any of those stocks, and I personally would be fearful of how this ends. I would not want to be one of the last 2 people with 1 chair left when the music is playing, trying to be the last one to sit down.
All right, very good. Thank you very much for your thoughts on that. Next question. For someone who has, say, $10,000 saved, what's the best way, what's the first step they need to take to go about investing those funds?
I can grab that. If you, so, you know, obviously, let's assume you have an account open and the money is in your account. So what should we do? You know, if I use the simplistic model that I sort of outlined for you guys, I would think of that as I'm going to put 75% of that domestically and 25% of that internationally of the equity component. And then I need to think about, to Jeff's point, of that $10,000, do I need any of that? You know, am I going to need $1,000 of that in the next 6 months? Or is it truly, it's $10,000, I don't need to touch it, I can sock it away. If that's the case, you don't need to touch it, you can sock it away. You could invest 100% of it in the market if you wanted to, in my opinion. If you were going that route, again, I personally would be one that would not put all 10,000 in immediately. I would go back to my idea of dollar cost averaging. And, you know, that's sort of personal preference. Do you want to put $1,000 in a month for 10 months? Do you want to put $2,500 in for 4 months? but that's how I would think about it. You know, 3/4 or so domestic, a quarter or so international, and then sort of the same outline that I gave: large cap, mid cap, small cap, developed markets, emerging markets. And that would be my quick answer.
I think I would just add to that. I think to your point, Mark, do you need the money? Because that, I think if you need an emergency account set aside. Investing is volatile, and we have to think about, can you get to it if you need it? So it's important to have some money set aside that's not invested, that's in a mutual fund or in a money market account. It's not going to earn you much, but it's there and it'll give you peace of mind and help you get through emergencies without having to sell an investment at an inopportune time. For the portion of that you don't need, that you can invest, then you can open up a brokerage account to start investing it, and think back to those different kind of accounts and see which one has the best opportunity for you, which one makes sense. Open up an individual, or can you open up a Roth IRA or some other type of an account. The mutual fund, as Mark talked about earlier, buying a mutual fund or ETF is a lot easier than buying individual stocks, especially if you're just starting to invest, because you can get that diversification a lot easier. And there's some that are allocated or diversified in and of themselves, that have the percentage already in them of stocks and bonds. They can be target funds that they're designed to get you to retirement or a different age. So there's different ways to invest it to keep it simple at the beginning as you start understanding the process. But again, time is your biggest asset. So if you're starting to invest, to get the process going and to give it the time to compound and grow is the best thing you can do.
All right, thank you both. Next question. So this one came through on the chat. Can you explain what a backdoor Roth IRA is? Rhonda, I'm going to let you handle this one first.
Yeah, I'm happy to talk about that. So when we talk about investing in a Roth IRA, there are some regulations that go along with it. There's some limitations on how high your income can be to put money directly into a Roth IRA. So if we have folks who are in a tax bracket that they can't contribute directly, then they might have the opportunity to make a non-deductible contribution to an IRA account, and then move that amount from the IRA into the Roth. So that movement to get it over is then called a conversion. And so it's a way to get the money into it. You can also convert money that's already in an IRA to a Roth. When you do that, you're gonna, unless that went into the IRA after tax initially, when you convert it to a Roth, you're gonna pay tax on that conversion amount, but it gets it in that Roth vehicle so that from that point on, it can grow tax deferred. And as long as you meet that criteria of 5 years and 59.5, you can pull it out tax-free down the road. As you're deciding whether or not to make that decision, though, you really want to look at your tax bracket and how much you're paying, and consider, you know, are you in a higher tax bracket now than you think you'll be later? In which case, does it make sense to convert it now, or should you wait till down the road? And then also you need to think about where the money's going to come from to pay the tax on that conversion. So two different issues, really. The backdoor Roth is getting money into a Roth when you don't qualify to put it in directly. And then the conversion is how you move money from an IRA into a Roth.
Mark, any other thoughts?
I think she covered that fairly well.
Let me ask you this. So if a person was going to convert a traditional account to a Roth account, under what general market conditions would that make the most sense?
So normally in a down market is when you would do that conversion, because as Rhonda said, when you convert a traditional IRA to a Roth IRA, you're paying tax on the full dollar amount. So when the value of it is less, you're going to pay less taxes. So in general, that's the best time to do it. The other way you can think about doing it is, setting up a schedule of, let's make the math simple. I have a $100,000 traditional IRA, and I'm going to convert $20,000 of that a year over the next 5 years to smooth out my tax bill. That's another way you could think about doing that. And I'll leave it on there on that.
Rhonda, anything else to add?
Yeah, no, I absolutely agree with Mark, because the goal is to get the investments inside the Roth as quick as possible. So in the down market, you can move more shares at the same dollar amount and then get them over. And then when the market comes back up, the growth is inside that Roth instead of being inside the traditional IRA.
All right, very good. I think this is probably our last question. So this one's for the college students. So how much money do you recommend a college student set aside for investing? Is there a certain percentage rule?
I mean, I'll give my opinion. I don't, honestly, this is different for everyone likely. It's all going to come down to your cash needs, how much debt you have, things of that nature. I will give you my bias. I am one that is very debt averse. So my opinion is normally, if I have student loan debt, I want to work to pay that down first before I'm investing. But that's just my bias. And curious what Rhonda's response is on that.
Yeah, so I agree as far as being debt averse, but I do feel that it's good to get in the habit of investing and to get in the routine, even if it's just a small amount, and start that process and start putting money into some type of an investment vehicle and let it grow. And you can have two focuses at once, both on paying down debt, establishing what your financial circumstances are, but building that portfolio at the same time.
Okay, I think that's all the time we have. Shelley, you going to join us again?
I'm here. So thank you, panelists and attendees, for joining us this afternoon. We hope you received some great information. Please watch again for that follow-up email that will be coming from the Alumni Association over the next few business days. That will have the recording of this session, contact information for our panelists, survey link for feedback, and they've also provided some great resources to you all for getting started or diving deeper as well. So if you do have suggestions for future BearTalks topics or would like to recommend MSU alumni speakers to serve as panelists in the future, please share that on your survey. Our next BearTalks webinar will be Thursday, July 8th from noon to 1 p.m. Central Time. The topic is Lessons from Entrepreneurs. So in this webinar, MSU alumni panelists will discuss their entrepreneurial journey, offer advice on launching a startup, sharing tips on obtaining outside investment, and much more. Attendees will also learn about the eFactory, which is MSU's Entrepreneurship and Innovation Center. Registration for this session is now open, and we'll send that link to you in the follow-up email as well, so you can get signed up for that too. So again, thank you everyone for being part of today's presentation, and have a great afternoon. Bye-bye.